Hey, welcome back to our channel. This is Doc Denton with Denton Property Group of eXp Realty here in Chattanooga, Tennessee. Today we're going to do a short video about PITI starting right now. Many times when we're working with home buyers, first-time home buyers especially, they are overwhelmed with the terms used on the mortgage side of the home buying process. We thought we would take a moment and discuss one of those terms that is most talked about. PITI. No, it's not something you make a sandwich out of. It stands for principal, interest, taxes, and insurance. These four items comprise what your monthly payment to the lender will be. Now you know what it stands for, let's discuss what each one of these items means and where each portion of the payment goes. Number one, P stands for principal. The principal portion is the total amount of money borrowed from the lender. Let's say that you borrowed $300,000, your principal would be $300,000. Each month you make a mortgage payment, a portion of that payment will pay down the principal. Unfortunately, this amount will remain the same for the life of the loan. 2. I stands for interest. Your interest portion is the amount of money the lender charges you to borrow their money for you to buy your home. It is determined by several factors, such as A, your credit score, B, the amount of money you are borrowing compared to the price of the home you are purchasing. This is known as loan to value or LTV. And C, the amount of debt you owe compared to the amount of income that you have coming in. This is known as debt to income ratio or DTI. Now there are two types of interest rates when it comes to financing a home. There's fixed rate and adjustable rate mortgages. As the fixed rate describes, this rate remains the same for the life of the loan. Now with the adjustable rate, the loan does just that. It adjusts. This usually comes with an introductory fixed period such as a 2, 5, 7, or even 10-year fixed period. After that introductory period, your rate can then adjust to whatever the market conditions bear. This means your payment could go up, adjusting up, or it could adjust down for the remainder of the life of the loan. Number 3, T stands for taxes. Your taxes portion is the amount of taxes that your local government charges based on the property's value. This is an instance where that $300,000 house, you would really love it to be assessed for just $150,000. These taxes are assessed annually and the amount is then divided into 12 payments and paid to your lender. They are held in what is called an escrow account, and when the tax bill comes due, the lender pays the taxes on your behalf. Now these amounts can fluctuate based on your property's value and can increase or decrease. Your lender's service provider will alert you to any changes. Number 4, I again. This time it stands for insurance. Your insurance portion is the amount that your insurance provider charges you to insure your home and its contents. This covers you in the event of an accident or a disaster, and it's required by your mortgage lender. And as with the taxes, this amount is billed annually and then is divided into 12 equal payments and collected and held in that same escrow account and then paid by the lender. Okay guys, please understand we are not mortgage experts, but we can certainly put you in front of the best in our area if you have more questions or need to get qualified for a loan. We hope that you learned a little bit about what makes your payment seem like it was one amount and then, wow, now all of a sudden it's a different amount. Now that you know what PITI is, let's go find your dream home. If you haven't subscribed to our channel yet, please do so following the link above. We do post content regularly.